Stock markets have fallen tremendously during the past few months, but a few experts believe things are bound to get worse. Famed investor Jeremy Grantham has a bearish view of the market, and he is of the opinion that the economy could see further market crashes soon. Listen to his explanation in a podcast he did with Trey Lockerbie. The stock market has performed poorly over the first half of this year. When compared to its all-time high of $4,818 and its recent low of $3,636, the S&P 500 has experienced a fall of approximately 25%. After the Wall Street tide and GMO regulations a few days ago, Jeremy Grantham is urging small investors to be wary of the equities market's short-term relief rally, and he is expecting more suffering. Grantham of GMO is of the opinion that before a market crash similar to the Great Depression of the 1930s, the stock market would exhibit a brief period of appreciation, which will ensnare novice or day traders and then ruthlessly massacre them. According to Jeremy Grantham, nothing is stopping the market from declining below fair market value. He anticipates that the S&P 500 will fall by an additional 25% from its current level, and that the situation could worsen after this. Grantham claimed that it is difficult to predict when the market downturn will finish. Grantham bases his argument on the idea that as recession worries grow and interest rates go up, corporate profits would decline. Jeremy Grantham has been claiming that the equity market and the real estate market in the United States are both in a super bubble for the past year. This super bubble was generated by a period of widespread speculation in volatile investments. Grantham argued that those who invested into this speculation would pay dearly as previously sky-high stock prices continue to fall to more sensible values in the coming year. While the stock and real estate markets have already rewarded pensioners, Grantham pointed out that individuals in their mid-career are more vulnerable to the economic superbubble popping than their older colleagues. Workers in their 20s and 30s will have plenty of time to see their investments revive. In order to fully understand and keep up to speed on Grantham's bear call, watch the video until the end.
I would argue that the termites got into action quite a bit earlier. You expect them to go for the juiciest speculative things first. And the king of the specs, in my opinion, was my own ill-fated QuantumScape. That peaked out in December 2020. It was the leader of the gang. It came at 10 like all SPACs. It went shooting up to 132. At 132, it had a market cap of 55 billion, bigger than General Motors and bigger than Samsung. QuantumScape, a research lab, a very good research lab working on a solid-state lithium-ion battery, half the weight and volume, rapid charge, no fire. It would be very nice if it worked out, but back then it still had 4 years to go before it had any sales or any profits. And it sold for more than General Motors. You have to admit, that is a candidate for the biggest spec of the cycle. Bigger than anything I can find in 1929 or 2000. Got to remember in 2000 that the pet.coms were scores of millions, or in a few cases, a few hundred millions. This was 55 billion, adjusted for inflation, adjusted for anything. That was a monstrous demonstration of the ability of the market to think deep into the future and have positive thoughts. Anyway, that peaked out in December 2020. In January 21, the number of new issues peaked. In February, the outperformance of the new issues peaked out. And in February, also ARK peaked. ARK, a exchange-traded fund of about 30 growth stocks that are very early stage growth. Most of them had no earnings. So that was exactly where the termites would be expected to go to work. And then a month or two later, the meme stocks with little or no earnings, like AMC and GameStop, they peaked out. And the whole Russell 2000 although it technically peaked in November, by early February of 21, it was about the same. It plateaued for over 10 months, almost 11 months of 21 before going down. So they had been rolling over, and 40% of the NASDAQ before December 21 were down 50% or more. So anyone who was into deep speculation knew very well that the bubble had started to lose air long before the end of 21. Okay, so that's one point I'd like to make. Secondly, the first half of this year is about as fast as stock markets ever decline. I remember seeing that the first 4 months was the fastest decline in the S&P since 1939, when I was 1 year old and they were preparing for World War I. So that's a pretty good excuse to go down. And this was the fastest decline. This is about as fast as markets go down. And they always have good rallies. There's nothing as quick and spectacular as a bear market rally. They had one in late 1929 to early 1930, an absolute doozy of 45%. And of course, with historical hindsight, they signify very little, but at the time, they frighten the pants off the bears. And they give hope that all is over, all is forgotten, and it's back to the races. And I suspect we may very well have a pretty decent bear market rally as we sit. I wouldn't be surprised if this went on for at least another month.
Interesting. Just on that last point there, is there a certain floor? I know you're a big fan of reversion to the mean. Is there a certain floor that we might bounce from, or that you're kind of expecting things to capitulate at?
In terms of the entire bear market, it would be unusual for it to bottom out anywhere near this high. I would expect that by the low, that the S&P would have declined by 50% from the peak in real terms. So you do have to adjust the stock market for inflation. And also the trend. The trend in the market is a little over 4% a year. And as time passes, you should put that into the fair value. So a year from now, when the bear market might end, the trend line value would be almost 3,000 on the S&P. Of course, there's no rule that says you stop at fair value. Typically, in previous big bubbles breaking, they go down below that. They went down below, of course, in the housing bust of 09. And they went down in every great bear market break, they went below trend, except Alan Greenspan's specialty in 2000. In 2000, the S&P was heroically overpriced. It came down 50%. But at 50% decline, it was only fair value. It only hit the trend and then bounced as the Fed raced to re-stimulate. The NASDAQ went down 82, and that's a lot of pain. And it's possible that would do that again. But you do have to adjust for inflation. There was very little inflation around in 2000. But this time, with inflation running at 8 or 9, it does move the nominal value of the S&P upwards, and one shouldn't lose sight of that.
I'd like to stay on this idea of fair value for just a second. So I've heard you say that today's market action looks superficially like the dot-com bubble of 2000. But one really interesting thing about that market was that the internet stocks were sometimes hardly even creating revenue, let alone profit, right? So it wasn't terribly difficult to see that these companies had a high cash burn and they were running towards a cliff. The main companies that survived are all now wildly profitable and some of the best business models the world has ever seen. So given the recent decline in the NASDAQ and the mainliners that are making up 20% of the S&P 500, do you think any of them are nearing a fair value now?
I don't include the classic FANGs as being in the super speculative category. I think you could throw Tesla in at its peak. That was super speculative, great company, but a bit of a silly price there. But the others, like Amazon and so on, they're great companies, but I wouldn't have included them as super specs. And yes, they're down quite a lot. It's hard in a bull market to get your brain around what happens in a bear market. Let me go back to Amazon. Amazon in the 2000 bust didn't just come down. As its sales continued to grow, of course, in those days, it didn't have earnings because it was running on borrowed resources. It didn't have to. It was still growing like the wheat. It came down 92%, with strongly rising sales. A brilliant, successful new idea that went on to own the world and be worth a fortune. How is it possible it came down 90%, 92? So think about that sometimes as you go to bed. 80% of the time, the market is pretty sensible and doing a possibly good job of estimating value for all the companies. A little under 15% of the time, it gets carried away with optimism. By the end of that time, has nothing to do with actual earnings. It's all in the head, projecting out hundreds of years into the future, assuming that perfect conditions will stay perfect forever. Every bubble takes place with near perfect conditions and huge profit margins. And the market runs with that and assumes it will stay there forever. And of course, conditions mean revert, profit margins mean revert, and good times become bad times. And that is a problem. And the remaining 5%, the market gets carried away on the downside and starts to be completely irrational, as it was beginning to be in March of 2009. It was getting pretty silly, pessimistic. I wrote a piece, Reinvesting When Terrified, that by sheer luck came out the day the market hit its low. And it said, get a policy, get a plan, present it to your committee or yourself, and start to throw your money back into the market. You feel paralyzed, everyone always does, and now's the time to wake up, the market is cheap. And of course that happened in 1974 and 82, which were classic lows when the market got down to 7 PE. And what I call terminal paralysis sets in, where you're so frightened you can hardly move, you can hardly get to work, forget buy stocks. And that's, of course, as Warren Buffett would have said, that's exactly the time you have to do it. And it's only 5% of the time. They're much quicker than the crazy bull markets.
What did you guys think of Jeremy Grantham's analysis? Do you believe that the stock market is bound for more crashes? Share your insights in the comment section down below. If you enjoyed this video, kindly like and subscribe, and we'll catch you on the next one.